Well, hello, everyone out there in Blanke, Schein Wealth Management land. We really appreciate your time today. We've got a lot of clients and friends and family that are joining us for our Zoom call. We got a very special announcement. But before we get to that, we are going to just talk about a little things about what we're planning on doing for you here at Blanke Schein Wealth Management. You know, we believe that information is power, and our job is to create real-time, relevant, market-related conversations, if you will. And we started that a year ago when I came to you directly through YouTube, simply because we needed daily updates. The news cycle that we saw, that we had our empirical evidence, our daily research, there was a major disconnect. We knew that markets, based upon our research, were going to go in a different direction versus the daily headlines. And so that was when our team got together and said, how can we do this a little bit differently? And we just came directly to you. So since then, our YouTube following has blossomed. Our business has just grown dramatically. So we thank you, everyone out there. And more importantly, our clients have done extremely well. And that's because we believe that, like I said before, information is power. And we're going to continue on our mission to create quality content for you. And we're excited to announce today that I have a new strategic partner that's joining us at Blanke Schein Wealth Management, and it's Stephanie Link. Stephanie, how are you today? Welcome, and thank you for joining us.
Thank you. It's so great to be here. And yes, you're right. I mean, the markets are always humbling, that is for certain. And it's no change now.
No change now. And we're going to get to all of that, but I really have some exciting announcements. Stephanie's come to us as a strategic partner. She's been with HighTower for, well over 6 months now, but you see Stephanie on daily, if you're watching CNBC or if you're a fan of the markets, she has an amazing 27+ year career on Wall Street, which doesn't seem like if you look at her, but more importantly, she's worked with managing portfolio with Jim Cramer at TheStreet.com, as well as a few other Nuveen, and overseeing $3.7 billion of assets under management. We are excited to announce that exclusive to us here at Blanke Schein Wealth Management, and our clients now have access to your brilliant portfolio management skills. You're also joining us as a strategic advisor for our investment committee. And, looking into the future, a year from now, we're going to invite Stephanie out for client meet and greet, an in-person meeting. But right now we're going to do it through Zoom so everyone's safe and healthy. But Stephanie, welcome.
Thank you. I can't wait to see you in person, really, truly. I know Zoom is a nice alternative, but there's nothing like face-to-face. So you just say the word when we can, and I'll be there.
It'll be great. And yeah, there is Zoom fatigue. One of the things we're also excited to announce, in addition to the addition of Stephanie from a strategic standpoint, is we're in the midst of creating, so to be followed. Hopefully this can be converted to a podcast. So we're working on our omni-channel approach of communications. So you can basically take Blanke Schein Wealth Management anytime, any place, whether you're on the go, if you want to share with friends and family, we're happy to do that. So we're working on the Wealthier podcast, everything all related to the retirement world. Wealthier Retirement is sort of in R&D right now, and maybe this will be our first podcast that we load in the next couple of weeks. So hopefully that gets to you and we can share that information later on. But Stephanie, let's start out with, tell us your overview of the markets. What's going on right now? What do you see? How's year to date going?
Oh, year to date's great. I'm knock on wood, knock on wood. As you kind of mentioned and alluded to, it's been a heck of a year, right? I mean, a year ago, just about a year ago, we saw the lows in the markets and we had to shut down the economy. The global world shut down, and there was so much uncertainty. So the market fell 30%. And what happened is that we just got a huge stimulus from the government and as well from the Fed. In terms of all kinds of liquidity, right? We have had, if you add up both the fiscal and monetary policies that have been put in place in the last year, it's 55% of US GDP, wow. Over $100 trillion globally in terms of stimulus. Money supply, which is just another fancy way of saying liquidity, is up 26% year over year. Just to put that into perspective, historical average 5% money supply growth. So you've had an enormous backdrop of liquidity. You've had very, very low interest rates. That's part of the Fed's move in terms of keeping interest rates quite low. So you've had liquidity, very low interest rates. A year ago, I look back and say, it wasn't easy to buy. It wasn't easy to really get aggressive on equities, but I did, and I think it might even be harder today versus a year ago, because last year everything went on sale. You got
Yeah.
the best and the biggest and the most blue chip companies on sale. Fast forward a year, well, guess what? We're up 80%, the S&P 500 up 80% from those lows. And so, and many stocks and sectors like technology are up even more so. So now, where are we? Now we are still very much in terms of liquidity. In fact, we just got another fiscal package passed in terms of from the Biden administration. And quite frankly, I don't know about you, but I was actually surprised they got the price tag that they were actually asking for.
Yeah,
right?
you're right.
I mean, we were kind of like hearing, nah, you're not going to get a 1.9 trillion. You're going to get maybe under a trillion. So the point of it is that there's more coming. And one thing that I just think is really important, these policies that are put in place, it takes a really long time to filter through the economy. You don't just all of a sudden say, okay, we're going to throw out all this money and it's all going to be embraced and absorbed into the economy. It doesn't work that way. It takes a very long time. Now, consumers have seen checks faster than would usually be the case, which is great news. However, a lot of the part of the economy has not seen all of this massive tailwind in terms of the liquidity. And so it usually takes about 12 months to get filtered into the system. So if you think about it, we just started a year ago in terms of putting the liquidity in place, and now all of a sudden we're starting to see it. So we are seeing better growth. You and I talked about this a while ago. We had been starting to see that V-shaped recovery in manufacturing and housing and auto, and even parts of the consumer. That was the good. The bad was leisure, travel, entertainment was still really suffering mightily. Small, medium businesses still very much struggling, and they still are even to this day, which is why you did need a little bit more fiscal to help on those pockets of the economy. But I think now what you're seeing is it's broadening out. Now we're seeing not only these areas of manufacturing and housing and auto, you are starting to see reservation rates go up.
Yeah,
you are starting
tremendous.
to see hotels seeing a little bit more in terms of occupancy. You are seeing people wanting to go out and about. And there's one thing, we can talk about all the details if you like, but there's one thing that I think is really underestimated, and I'd love to hear what you think about this. Consumer. So the consumer has now an excess savings of $3 trillion from the March lows. The savings rate is 20.5%, and historical is 5%. And so if you go from 20.5 and you go down back to the historical of 5% savings rate, again, that's about $2.5 trillion of consumer pent up demand. And so I don't know about you, because you live in a beautiful country and you can kind of get out and about, but we've had a heck of a winter, really snowy, really cold, and I can't wait to get out. And I know that the pent up demand is really what's going to fuel the next leg of growth, particularly from the experience side of things. I think consumers will still spend on stuff, but I think they're really anxious to go and travel and go out to dinner. And as I mentioned, just do things in general. And why that's important, you know this better than I, but 70% of the US GDP is consumer. So we need them to spend. We want them to save, by the way. We don't want them to spend at all, but we want them to spend and we want them to feel good and for consumer confidence to stay abundant so that it can continue to drive our economy. When you add that to manufacturing continuing to improve, when you add that to autos continuing to improve, there's a lot to be excited about. There's a lot we still need to fix. But for now, I think in 2021, the story is we're going to see better GDP. We're going to see better earnings. And I think that is really, those are two things that are real nice tailwinds for the markets, for equities. And I think interest rates, while they may tick up, and we can talk about that as well, they may tick up a little bit more. I don't think they get out of hand. The biggest thing I would watch would be inflation. Right now, you're seeing commodity inflation, but you're not seeing unit labor cost inflation, wage pressures, right? You're not seeing any of that yet. Right. And that's when we worry. So
that's when it tips
I don't
the
know.
scale.
What do you think about? I mean, are you excited about the economy and what we're seeing and the consumer and all that?
Yeah, Stephanie, everything you just summed up was exactly what we're seeing. All the not only the research that we're reading, but the empirical evidence, right? The channel checks. You go back to, a few decades back with Peter Lynch, and he used to go to shopping malls with his daughters, and that's how he discovered, his next best thing for Fidelity Magellan. And then you have channel checks, as Jim Cramer used to say, and he's still talking about that. And I most recently, was with a buddy of mine who is CFO of a company that basically is the portfolio management of all of the leisure hotels. And he said one of their properties back upstate New York right now usually does $20 million on annual revenue pre-COVID in EBITDA. Right now, they're projected to do 40 million in EBITDA.
Wow.
So everything is, and so if you look at yesterday, I saw you on CNBC, and you were talking about sort of the reopening trade, the travel trade. We personally at the Schein residence, we're always looking at, okay, when we can go out and travel and so on and so forth. If prices are going up, so there's price inflation built in, the demand is coming back online. That's why I love your portfolio specifically, is because you're geared towards, that reopening trade, but more importantly, the travel sector. Because, I saw CNN the other day, international, I'm flipping through, and they had a headline on there that I was scratching my head on. But you have to think about it. We're Americans, the US consumer, like you said, 70% of the GDP. Give it, Congress and Wall Street and Washington are no strangers to how this works. You drop dollars, helicopter dollars into the hands of the US consumer. Is that going to be saved? Absolutely not. Are banks paying you for it? Absolutely not. In fact, you're being penalized because of the inflation threat. So what's going to happen? It's going to go into the balance sheets, right? If they're smart, well-executed companies, they're going to capture those dollars that are already out there that you just pointed out. But the headline actually said, internationally speaking, now keep in mind that retailers in the US are prepared for American revenge spending. I didn't know that was a term, right? There's American revenge spending now. And to your point, when there's all clear, vaccinated and everything else gets along its way, and it's progressing nicely. We're going to see this. So we are very optimistic as it relates to the right sectors, the right stocks, well run, well managed, and positioned appropriately. But I will tell you, from a travel standpoint, there is a lot of room to run if you just look at bookings, occupancies, TSA, daily upticks, all of that stuff. So
it's funny that you say that about just thinking about hospitality and that sort of thing. Barry Sternlicht, one of the most brightest CEOs, he is at Starwood Hotels. And he's one of the brightest men in the industry, investors, just a terrific person too. I happen to know him. And he said in Florida, his properties in the south of Florida, more like Miami and that sort of area, he said that the revenues per available room, that's how we measure that kind of, right, RevPAR. He said that this past month was better than even 2019. So he had expected to see an improvement from 2020, but even it's better than, so to your point exactly, the example you gave, so we are getting these anecdotal data points. And I will just simply say, I hadn't been on a plane in a year, and fortunately we were able to go away last week for my daughter's holiday break from school. The airports were a mob scene, an absolute mob scene. Now, good news is everyone was wearing masks. Some people wearing 2 masks. Everybody was socially distancing. So everyone is still really, I think, mindful that we still have a little ways to go, especially in the tri-state area, because we're really not all that vaccinated up here. But that being said, to your point, yes, I love that revenge spending comment. I might even use that and give you credit on CNBC.
Go for it. That'd be great. Well, Stephanie, let me ask you a question here. Your portfolio very specifically, and I really want to sort of frame this up for our clients. We at Blanke Schein Wealth Management, we manage money on a discretionary basis based upon, first and foremost, fundamentally speaking, your financial plan. So we create a financial plan that's tailored and customized to your family, your current situation in life, your goals and your feelings. And that really dictates what we call risk tolerance or investment policy statement. From that, we build the asset allocation framework. And then from there, it's basically a mix of, our clients are retired and small business owners, and they like where they are in life. They want to stay comfortable. So they want to stay right where they are. They want to grow, stay ahead of inflation, but they definitely don't want to go backwards. And they also want to think about tomorrow, right? Their future legacy. So that's sort of how it's slow, steady, boring. But at the same time, it's the right companies and the right investment strategy. So with that asset allocation and that in mind, obviously cash flow is king for our clients. We then dictate sort of how we allocate portfolios, of which then we go to the greatest minds out there. In this case, Stephanie is part of that asset allocation strategy, and she has a large cap core strategy. And essentially the take home point is it's a balance of growth and value, large companies. And what I love about this portfolio, Stephanie, is that you said something very important. It goes back to my Wharton Business School investment management consultant days, where we looked at the people, the process, the portfolio, obviously the pricing, the philosophy of how you vet a portfolio manager, of which you said our last conversation, which wasn't too long ago, in this portfolio, you have not only a constituency of, let's say, I don't know what most recent is, but let's call it around 40 holdings. But you said specifically, you have met and talked to and know all 40 of the CEOs in the portfolio that you manage here. So talk about that, because I think that's exceptional.
Well, thank you. And I think a little bit of it is it's a sign of age, right? I've been doing this for a long time. So I think the managers, the CEOs, they see me on TV, but they also, I've done many, many meetings. And I have always found, and I'll tell you, this really actually stems from my Jim Cramer days. Okay. You want to find blue chip companies. You want to find number one or number two in each industry, and you want to find an opportunity to buy them on sale, right? So it's almost like we call it growth at a reasonable price. And as you mentioned, it's a large cap core portfolio that I run. It's a little bit of growth, a little bit of value, and I can be somewhat tactical if I really believe that the environment strategically is changing. And in this case, in the past year, yeah, it has changed because of all this liquidity leading to better growth. And so it's really been this year and the last maybe say 6 or 7 months that we've seen a rotation in the marketplace. And so if I think the economy is actually going to recover, which I do, as I mentioned, I do think you want to be and have exposure to economically sensitive companies, more cyclical companies, maybe a little bit of a bias towards value. I do not want to give up on growth. I know you and I talked about a lot of different end markets, and we're in total agreement in terms of where you want to be within technology, within healthcare, and the end markets. And we can talk all about that if you like. But it goes back to, yes, if you can own a company that has a strong balance sheet, good free cash flow, good market share, then you have to actually marry that all up with the management teams. And it's not only the CEO, it's the bench. Do they have a good bench? And not every management team is going to get it right 100% of the time. There are going to be times when companies falter for whatever reason. And you want to make sure that you have confidence in the CEO and the bench that they can fix it if they need to, make changes, do M&A, do a restructuring, whatever it is. I want to know, does the management have that experience and do they have that track record? And that's why meeting these CEOs is very, very important. Most recently, and we can get into names if you like, I've had probably 3 or 4 CEOs actually reach out to me after they've seen me on TV and just saying, you got this story, you got this piece of it right, and you got this right, and I'm so glad that you're supportive of us and this and that. And I just don't think that if CEOs, if their businesses weren't going well, they would never reach out. They're not telling me anything. They're just simply saying, you got the right message. And I just love to have that dialogue, because guess what? It's not always perfect. And when things go wrong, I want to have accessibility to them and say, okay, so how are you going to fix this? Or what are the challenges? Or what do you worry about? I think we talked a lot about one of the things I look for with CEOs, and it's all about what they're doing with their cash. Sure, I want them to buy back stock. I definitely want them to increase the dividends, and they have been. And these companies, the ones I own anyway, are flush with cash to do so. Are they doing any kind of M&A? And we saw almost over $1 trillion worth of M&A just in the US last year. We had record levels in October and November. And then we also talked about who started all that M&A. And it was Warren Buffett back in last July 6th, as a matter of fact, when he bought the Dominion pipeline. And he started it. He said, you know what, there are values out here and I've got cash and I want to deploy it. Because you know what, I love that they're buying back stock and they're increasing their dividends, but when they put the money where their mouth is and they say, we have confidence in the future, we have better visibility, and we have so much visibility that we're willing to shell out billions and billions of dollars because we believe that's good for our company over the long term. That's the kind of stuff I want to see. So yeah, so I've met them all. And sometimes I give them a little bit of hard time. It's not always perfect, but it's always respectful. And what I love about it is I learn something new every single time I talk to a company. There's one little nugget that I didn't know, or there's something that I didn't appreciate, or maybe the story has changed a little bit on the margin and I just didn't understand it as well as I thought I did. But again, I think it's you have to build a relationship, as do
Right.
you with your clients, right?
Yeah.
And you with other companies. That's the same way I believe in terms of investing. And I think that's extremely important.
That's wonderful, Stephanie, and thank you for shedding some light on that. Let's go to sort of your sell discipline. So,
Yeah.
When you find something on your radar and you put it through your process, and you decide when do you add it to the portfolio, and then ultimately the hardest question: it's so much easier to buy, it's hard to sell, right? When do you sell?
Yeah. It is very hard. It's very, very hard. And sometimes I leave money on the table, Rob. I do. I'm going to admit that.
I think
right?
we all do. I mean, that's the nature of, that's the nature of this industry. It's easy to buy, it's hard to sell.
It is hard to sell. First and foremost, I will sell if the strategy has changed.
Okay.
If something dramatic has changed in terms of the management team that I don't believe and I agree in, if the philosophy of the company and the reason why I bought a company to begin with, a stock to begin with, if it changes and I'm not comfortable with that, I will always sell. And you know what? It may work out great. But if I have a reason, I have a process, I have very much of a valuation discipline, and you're right, it is so much easier to buy versus to sell. But if something changes that I'm not comfortable with, then I will sell. Now, I am a pretty patient investor, and I would much rather, just like you, Rob, I would much rather buy on weakness. In fact, Jim Cramer used to make me put a list together of stocks that I owned, and he would call them levels. Okay, so you liked Google at 2150. Okay, well, it's now at 2000. Are you going to buy it? And he would always have and always make me put levels. What stock prices would I actually buy more stock? And I think that's really important because it's always easy to say, oh, I want to buy low and I'll sell high. Well, I mean, it's hard to do. Most people do not buy low and sell high, right? We know that. So I'd much rather buy on weakness, which is why it goes back to, I don't sell that often. I don't have a lot of turnover.
Good.
The only time I'll have a lot of turnover will be in an example of last year and last March, when there were so many things on sale where you could get the bluest of blue chips down 30, 40, 50% for really reasons that, people were just flushing out of the system and de-risking. So for me, I'd like to try to see the process and the story play itself out. So if something changes on the story, if a management changes that I'm not comfortable with, if the valuation is just too hard to justify. Now, it's hard because technology, we've seen what technology has done. What I try to do in certain sectors is I look at not only valuations, but I try to look at total addressable markets and what the growth in each industry is going to be, right? I mean, I'm sure you do the same thing, but technology in particular, because it really tends to swing really, really like one way or the other. But when you have total addressable markets of cloud of $1 trillion, of AI of $1 trillion in the next decade, when you have retail e-commerce going from 3.9 trillion in 2019 to 7 trillion by 2026, when you have wearables and you see all your kids are wearing the wearables and you're wearing them and I'm wearing them, and when you see that it's a $55 billion market in 2 years' time, those are the kinds of stories where I might let the valuation run a little bit because I see that they're going to grow into their end markets, and they're very steady in terms of free cash flow generators. But when a valuation hits my kind of target price, I really have to assess and say, okay, what do we want to do here? And maybe it's just as simple as trimming the position so that it's not so big, right? And so, okay, maybe you trim it. Excuse me, I'm sorry about that. Maybe you trim it, and then maybe you wait and see if in the coming weeks or months you get a better opportunity to add
it comes back to you.
Yeah.
So I mean, this last month and a half, we saw, and on my updates on YouTube, I would provide for clients, even before this actually turned out to be a tantrum in the 10-year Treasury. We saw, it's a game of chicken. The bond market, rules the day. It's going to send a message to policymakers. and it really has been running. And then if you look at growth stocks have pulled back as a result of those future earnings are going to be negatively impacted. And because it's a trade, basically, it's a it's going to take off future earnings based upon the 10-year treasury or cost of interest rates rising. And that's how that's the net effect of why growth has had a tough time year to date. Now, keep in mind, if we look year over year on a lot of these growth names, they're up. Obviously, the market's up 80%. Some of these are up 100 and 150%. So it's okay to have some consolidation. It's okay to sort of have a picture preview in the future as to when this great showdown will happen. I believe it's a moment in time. I believe it's a game of sort of credibility chicken and sort of who's flexing their muscle, whether it's the Federal Reserve talking about how they're going to keep interest rates lower for longer, and the bond market saying there's inflation and a few other things that are going to move this in spite of your best efforts, Federal Reserve, Chairman Jerome Powell. So this is what we've been seeing play out, and that's why on a daily basis. Now, the other side of that, so growth has sort of taken a breather, a setback, if you will. There's some opportunities coming our way, I believe. So we've been positioning ourselves accordingly as it relates to that. And then the other side, which you've been wonderfully you were in the last half of last year talking about almost on a weekly basis on CNBC about how you believe that value will have this resurgence, if you will. And that's what's great about your portfolio is that you have the best of both worlds, highest companies you've talked about in terms of quality management teams and, in their sectors and marketplaces. But value has been way outperforming growth this year. And what's wonderful about that is that you called that and you've been spot on. Talk about sort of the growth value trade that you see playing out right now.
Well, knock on wood. I mean, look, I think at the end of the day, 30% of what I do in my time is big picture strategy, right? Because that's the way I enjoy investing. I have to learn big picture. I have to know what's happening here in the States, what's happening globally. Where's the Fed? Where are the global central bankers? What's the liquidity? That's why I started off by talking about that. Where are the inflection points, right? And so that I start and think big picture. And then I figure out what I want to do sector-wise. Like, do I want to be overweight or underweight technology? Do I want to be overweight or underweight financials? And that kind of thing. And then the rest of my time is doing bottoms-up fundamental analysis, because I really truly enjoy that. But I will say this. Growth has had its day. Growth has had the last 10 years, quite frankly. They've had a lot of days, right? And so it's been tough to be a contrarian, to be more value biased. I will say I am more contrarian value biased, but I understand when there's a trend and you have low growth and you have low inflation. That's what we've had over the last several years. We couldn't buy inflation, right? I mean, the Fed has been trying for 10 years. No go. When you have low growth and you have very accommodative policy and low inflation, that's a recipe for growth assets. What changed last year was all of this liquidity went into the system, and no one really appreciated how much that was going to drive better growth. And we haven't even seen it. I think there's a chance you can see 9-10% GDP number this year. There's a good chance. I think there's a good chance you're going to see 35% S&P earnings growth this year. And it's all because of all of this stimulus. When you have better growth, you're going to naturally have a little bit more inflation, like you just mentioned, and I did as well, especially on the commodity side of things. When you have those two things set up, that means a little bit higher interest rates. All of those three metrics leads to value outperforming growth. And so that's where we are right now. And about 7 months ago, I just thought that the stimulus was going to work. And there is this old adage, Rob, you know this, don't fight the Fed.
Right.
You do not fight the Fed, and you don't fight the global central bankers. And everyone was running for the hills last March and in April and May. And look, it was scary. It was not easy. And I get it completely. But I've been doing this for 27 years. And anytime you do try to fight the Fed, it's been a mistake. At least in my career, it's been a mistake. And so I kind of felt like the Fed last March had to fix the bond market before you could fix the stock market, right? Because to your point, the bond market is kind of the tell, right? It's much more, it's a much bigger market, and they sniff things out. And so you have to pay attention. And so, look, right now, interest rates are rising, but they're not screaming higher. I love the fact that we're going up, we have a big move, but then we kind of settle back down. Right. And so you're in this consolidation. If we were to spike, in interest rates. That's something that the market's not going to like, right? Because nobody likes big moves in anything, crude or the VIX or anything.
Right.
So right now it seems sort of measured to me. Inflation seems like it is creeping up, and there's a lot of components that I look at that are showing within some of the manufacturing data that we've been getting, like the prices paid index, those kinds of things, they're going higher, right? Look at housing. The new homes, the median sales price rose 5.3% last month.
Yep.
And so
year.
you gotta watch some stuff, right? So watch the inflation, watch unit labor costs, because that's going to be the driver of bigger inflation. But I think we root for a little bit. I don't know about you, Rob. I root for a little bit of inflation, because that means we do have a little bit better growth. And in that environment, you definitely want to have, again, cyclicals, a little bit more value, marry it up, diversify away with some of the secular growth names. But I lean probably right now 70-30 cyclicals to growth. That's not to say that you're right. We're going to get opportunities to buy some of these things back. Well, let's just wait. Let's just wait, because I think people still aren't 100% there on cyclicals and value, right? I think they're still really tied up in growth, because that's been the place to be. And so I feel like I'm positioned where I want to be. I'm very mindful of when it sways one way or the other. We are hearing more people talk cyclicals, but I don't necessarily know if they're really positioned that way.
Yeah, Stephanie, you've been spot on. As I said before, you got heat on CNBC for it last year. And this year you are running the show, because you were spot on. So well done on that. And going back to don't fight the Fed. I mean, I spent a lot of time talking about the policymakers, both here and abroad, in terms of central banks. And I think, we all could agree. And I think that was the tell as to what Steve Mnuchin, Treasury Secretary, did, and Congress acting so quickly last year on how they basically said the message and the signal to the bond market. And I've said this many times to our clients, we got to watch the bond market, because the stock market's a sideshow.
Yeah.
Right. And so the bond market, I mean, Steve Mnuchin was brilliant when he basically said and forecasted what they're going to do. And ultimately, that was the signal that private money came into the market, and that provided the liquidity. So we averted a potential liquidity crunch, which then could have led to lower levels that what we saw. And the brilliance of that move was by him announcing it and signaling it and being crystal clear, but forecasting it, he didn't do as much as he had to do or needed to do, because everyone came in. And so by the time he actually got to, help the liquidity, I mean, it was a brilliant move. And what I think what the Federal Reserve does, as well as all of the policymakers and those that are brilliant in finance, know sort of a thing or two, is they learned from the last lesson. The last lesson was 2008, 2009. Both the policymakers took their time, as well as Congress took 2 or 3 attempts to get a stimulus out the door. And we could just watch it go down and down and down. And when clients said, how do you think, Rob, when we're going through this a year ago, how is this different than last time? And quite frankly, everything happens at a quicker pace, number one. But number two, for the first time ever, I saw fiscal and monetary policy work at a quick pace. Mm-hmm. And as soon as they did, that was a signal to the market. And last March, we never bought so much for our clients, because we actually had a position in cash strategically. And we were, it worked out very, very well. And simply because of what you just pointed out, you got to watch the big picture. And so going forward, so we talked about interest rates, President Biden tomorrow is going to have his first press conference since January 20th. He's going to address, it's going to be a Q&A. It's going to be very interesting to watch. It's we watch Washington, right? Because that's your and our tax dollars that are going to be redeployed within the US economy. And now they're talking about, like you said, the 1.9 trillion, I was shocked as that passed at 1.9 trillion. Like how they come up with that number and how it ends at that number. Like I thought that was the opening bid. I thought we were going to have an art of negotiation. That didn't happen. So now they're talking $3 trillion tomorrow. And, we could debate it, who it's going to impact negatively and how it's going to catch up to us. And, one camp's like, oh, the net interest borrowing cost is the cheapest it's ever been. And, God, who knows, if we have a 100-year bond, maybe we can, basically, refinance our way out of this one. And if somebody wants to buy that, fantastic.
That's awesome. No,
I don't know. I mean, that's the concern, right? That is a concern. Inflation will hit. And I talk to clients all the time, which is one of the reasons why we have to be positioned accordingly in terms of growth in our portfolios, because the Federal Reserve and all the policymakers are reinventing or inviting inflation, right?
yeah.
And so because you and I don't go buy a TV every day at Costco and it goes down by 30% per year on the TV, that's factored in the government CPI number. That really is a false read as far as I'm concerned when I talk to clients, because it's called CPIU, what you and I spend money on. And quite frankly, it's schooling for me, and that inflation cost is the highest. And the next one is medical. All of our clients are spending, doctor's appointments and medical bills, and that is just right there with school costs. So yours, mine, what we're spending money on is very different than the government read. So how we protect ourselves, how we position ourselves accordingly is into things that will outgrow and stay ahead of inflation, because banks right now are getting away with a crime based upon the net interest margin, and they are making money on our money, and they're not providing us a toaster anymore to keep our money there, right? So there's zero incentives, and they're loving when they see interest rates tick up a little bit because they're going to make money. So tomorrow we're going to have another $3 trillion in our economy that's going to be spent. We're going to follow what Washington is basically, how they're going to project they're going to spend the money, and we'll go from there. But what are your thoughts on the infrastructure bill?
Yeah, I mean, so I am right now 500 basis points overweight in industrials and also in materials and mining. So those are pretty big bets for me. I usually go anywhere from like 200 to 300 overweight any given industry, but I do feel very strongly exactly what you just talked about. We are pumping money into the system. More money's coming in tomorrow. The reason I think they're focusing on infrastructure, while we do need it, by the way, we all know that, and all over the country, but you and I talked about this on our last call. Manufacturing is only 12% of US GDP, but there's a multiplier effect. For every one job created in manufacturing, 7.7 jobs are created around it. So if you want to improve this 10 million unemployment situation that we're seeing around the country, this is where you focus. You focus on manufacturing because the multiplier effect is enormous. You'll get jobs you'll create more jobs, and again, you will, I think the industry, the manufacturing industry will boom, quite frankly. And all of this comes at a time when there's all kinds of supply chain issues, right? Because we basically shut the economy down and the world down for 2 months last year. You can't all of a sudden just ramp up a manufacturing plant. It takes many, many years to even build one.
We're still waiting for our washer and dryer that we ordered in October.
Is that right?
It's going to be delivered next week. So they say.
Well, that's awesome. I love that. So yeah, you're going to be all kinds of stats to go on TV. So I'm just going to give you credit. So don't you worry. But I will say, so the supply chain glut, better demand. Well, what does that even mean on pricing power? These companies are going to have enormous pricing power. And oh, by the way, they just spent the last year cutting costs and restructuring. So they're lean and mean. So margins have actually stayed elevated, right? And then imagine you get pricing power and imagine you get revenue growth. That's called operating leverage. And that's why I say cyclicals have been the place to be in anticipating that operating leverage, which will be far greater than any technology stock that you see. I mean, we haven't really seen it in a very, very long time. So these are the kinds of things that you remember, and these are the kinds of things where you want to have exposure to. I'm not saying you have to go crazy down the quality spectrum within industrials or within materials and chemicals and mining. You stay super high quality. You don't need to go crazy. Find companies that, again, great balance sheets and market share, good managements, and also find some dividend growth and dividend yields. I think that's very, very important, because even though interest rates are going higher, you can still find companies that have 3.5% dividend yields, which is well better than what you're going to get, right? Even with the recent rally in yields here. So to me, when I say cyclicals, pricing power on manufacturing and materials, but then also to your point of financials, a steeper yield curve. These companies are going to make a lot of money, and their capital levels are so enormous because they've had to increase their capital positions because of 2008 and the drama that we went back then. There are all these regulations in place. So they're flush with cash, and now they're allowed to buy back stock, and now they're allowed to increase dividends. super, super cheap. And I still think people are skeptical because it's really been this lost trade for such a long time. And
True.
so I think you have exposure there, you have exposure to consumer, you have exposure to your point on reopen, and then you marry that with some secular growth, as I mentioned, total addressable market stuff. And I think that's the way my portfolio will be positioned until something on the margin changes. What would that be? Does inflation get out of control? Does the Fed lose the curve, right? Or is it the fact that, guess what? They start to pull away from all of this stimulus. And those things are not going to be well received, I don't think, in the market. And so we might have a speed bump. But overall, they're not going to pull all of this liquidity. And to your point, we're adding another 3 trillion. So there's still so much in the system. So look for some air pockets, maybe a little bumpy choppiness, because we've had a nice run from the lows. But I think I'm looking for opportunity. And again, probably in both kind of areas, growth and value. And that's kind of why I like running a large cap core portfolio, because I can decide macro what I want to do. Do I want to lean a little growth, want to lean a little value, and I can kind of adjust accordingly without going crazy, and certainly not compromising quality.
That's great, Stephanie. So you did a wonderful job recapping sort of the worldview, the big picture on a short term. It's hard to be bearish with all of what we just laid out, the case we laid out. So short term, and our clients are long-term investors, as how you manage money professionally as well, long-term, long view. So let's switch gears. Since the short term is bullish, what could derail this? What keeps you up at night? I'll share with you the couple of things that I sort of communicate to clients on a long-term view, what keeps me up at night. And I think one, a client or our clients constantly bring up the issue of taxes, right? Will taxation take a bite of, is there wealth tax? Is it going to be corporate taxes? All of this. And as this has been sort of, it's always something that's never seen that's on the horizon that really takes us out. So one could make a case, how if taxes do rise, I think that will be still managed and positioned accordingly, according to companies, to be able to, navigate the new tax landscape, as well as individuals, because they'll work with professionals like us and your CPA and estate planning attorney, and we'll work to come up with smart, proactive solutions as it relates to that. So that is a situation. I think another situation that could possibly play out is what you brought up. It's not the entrance of the Federal Reserve, it's the exit. And you can use this analogy as well. It's always like a 2-year-old where you're taking the candy away, right? It's the Halloween bag and you're taking away, it's time for bed, and they're hooked on the sugar high, and that's taking away the quantitative easing or stopping the purchases of treasuries. And at that point in time, that's when the equity market, the 2-year-old, really starts basically getting ultimately inconsolable, upset, because they were so built for, this is wonderful, and the candy is going to last forever, and I may be on the sugar high forever. Well, we all know the hangover effect on sugar or anything else is never good.
Actually, that's very well said. Absolutely, taxes are a problem, and our deficits are a problem, right? That's why taxes are going to eventually go up, because we have got this enormous debt, this enormous deficit. I don't think in my lifetime, I don't worry as much about it, at least in the short run. But I do worry about the deficits for my 14-year-old and for your kids too, because I feel like that's really, we've got a couple of years before we're even going to have to really fully address it. Taxes are going to go up. Of course, we have to pay for all of this, but it's only going to pay for a smidge, quite frankly.
Yeah.
I think so. From a consumer point of view, you definitely want to watch that, because certainly they will get some consumers will get crimped. I think you have to think about also just regionally around the country, what's going to happen in certain states as people migrate to certain states where it's more tax friendly. I think corporations, if we went to 28% of the corporate tax rate, that's certainly better than the 34-35% levels it had been at the highs prior. But 28% probably hurts earnings by 10% for the S&P 500. I think it's manageable, because as I mentioned, margins and cost controls and companies being so lean and mean, I think they can control that. And I think we can get past it. So while I think it's going to be a headache for these companies. I think they can handle it. I think what I worry more about is what is it going to do to the consumer, and we'll have to just watch that, because that's a big part of the economy. And I think you really do need them to feel continued confidence. I can't imagine that they get anything passed from a tax point of view until 2022. I can't imagine in the face of COVID. And I get it. We're starting to reopen and I feel good about the recovery and all that. You still have 10 million people that are unemployed. You still have small and medium businesses closing every single solitary day. So I think we have to see how this whole thing plays out for the next several months, quarters. But over the long term, yeah, the biggest thing I worry about are the deficits and the debt. And I worry for our children, quite frankly. I really do. And so I'll worry for us too at some point. But I think the real adjustment is going to come, unfortunately, to them. And exactly to your point in terms of cost, where you're seeing inflation, I mentioned commodity costs, but yes, to your point, school, education, medical. And now we have to watch shelter, right? You got to watch affordability, because prices are going up. And the reason prices are going up is because there's no homes out there. There's only 2 months worth of supply in the system, right? And just, so I think there's some things you have to watch. But you know what? You know this just as well as I do. The market always climbs a wall of worry. Always.
Yep, always.
It's when we don't worry is when I worry, right?
That's when we worry.
That's when we worry.
You're exactly right.
So let us worry. Let us, you and I will worry. Let the clients let them be able to sleep at night, and you're going to take well care of them, and they should feel good that their money is in your hands.
So I think the take home point here is the one thing, if I were to go back on our conversation just now, and the one thing that really will take a bite into corporate earnings and markets would be unit labor costs.
Yeah.
If we have that rising, ultimately that's always been the tipping point, as you point out. And then you have a force that we've never seen before, which is technology. And those two are basically, it's the biggest technological revolution that really is revolutionizing this. And that's where we get will inflation, is it short term? Yes, we have hot spots, obviously commodities and lumber as an example, and affordability for housing and its concern. But then that should temper off over time. It's the unit labor cost, and it's always been the tipping point. So that's interesting. Very good point.
Well, and it's zero right now. It's zero. And a couple of the strategists that I talk to don't believe, and I don't know, we'll have to see how it all plays out, but because we've never seen we've never seen this chapter before. We've never right. in our history. So we have to see how it all plays out. But I do think that unit labor costs can inch up a little bit, but many people do not believe it's going to happen until 2022, maybe late 2022 into 2023. That's a lot of time between now and then. So I don't want to make that kind of a forecast. But if if you want to think about just a trend, it can't get much lower than zero, right? So
yeah, right.
Watch it. And so we just have to watch. But an excellent point you made, Rob, is we have technology, and the productivity has been incredible from technology. So perhaps it really is different this time. We'll see.
Yeah, we will see. We'll look back to this. Stephanie, any last departing comments? We've been together for a good 50 minutes now, and I want to be respectful of your time, as well as our clients and everyone else that's watching here. I could literally speak to you all day, and we can have some fun. We're gonna have to do this again next time. But before you leave, are there some things for us to think about, or any last comments you'd like to make?
Yeah, this has been fun. I know. I feel like you and I could talk for hours on end. I mean, it really is quite amazing, and I don't say that about a lot of other folks, right? So we're very passionate about it. We're both very passionate, and I think that comes through for sure. I just say, someone asked me, because it's National Women's Month this month. So, just a congratulations for all the women out there and all their hard work. People used to say, kind of what drives me. And I used to say, well, I want to be successful. I want to make money. But, as I get older, yes, those things certainly are there, but also enjoying what you do is very, very important.
Right.
And I enjoy what I do. I really do. It's like my laptop is always open. My poor daughter, she sees red and green on the screens from Bloomberg every day. And she's like, what is that, Mom? Why is there so much red? And I'm always like, go away.
Yeah.
But it's something that you either have in you that you really want to learn and to remain humble. but also, you know what, you're going to make mistakes, but you learn from them. That's the thing.
Yeah.
If you learn from the mistakes, that's where you really learn as an individual. And so I truly have a passion for it. And I know you do too. That's why you're so successful as well. And I think at the same time, I love to like, A, not only talk with you, but B, also talk to clients and also talk to others and teach and coach and learn and at the same time. So I stay humble. I don't know what's in store in the coming, years ahead, but I know we'll both be brainstorming and keeping our head down and doing the best that we can. And again, smiling along the way is really an important thing.
Stephanie, you're such an inspiration. We are so blessed to have not only our time together, but have you in the fold of Blanke Schein Wealth Management as a strategic advisor. And we are so looking forward to that opportunity for you to come out here and spend some time in beautiful Southern California when the time is right. Next winter will be just fine. And we'll get you out here. We'll do a private client event, and we will continue the conversation. Between now and then, if any of our clients at Blanke Schein Wealth Management want more information about our conversation today or the portfolio that Stephanie will be managing, or any questions that you have, any follow-up conversations that I can, run with Stephanie in future conversations, we can run back to you and report back. We're happy to do so. We appreciate everyone's time. We thank you for the opportunity to serve you. And from everyone at Blanke Schein Wealth Management, you guys have a great day. And Stephanie, have a great day too.
Thank you so much, Rob. Take care. Be safe.
You too. Take care, guys.
Okay.